Imagine you were buying just a massive shipment of goods from a supplier on the other side of the world.
Right.
You've wired the funds, the factory has produced the inventory, and you are tracking the progress online. You're just counting down the days until it hits your warehouse.
The standard supply chain anticipation?
Exactly.
Yeah.
But halfway across the ocean, the unthinkable happens. Like a freak weather event hits, the cargo ship lists to one side, and your containers tumble into the freezing water,
Oh, wow.
sinking straight to the bottom, just totally gone. And in that exact moment, a terrifying question arises. Who actually pays for the lost cargo?
Yeah, that is the literal nightmare scenario.
Right. Like, are you, the buyer, on the hook for millions of dollars of goods you never even received? Or does the financial hit fall on the seller?
And that scenario is exactly what keeps supply chain managers and CFOs awake at night. I mean, if companies had to litigate that question from scratch every single time a ship went down or a train derailed, global commerce would just...
It would grind to a halt.
An absolute halt, yeah. The legal fees alone would completely bankrupt the system.
Which brings us to the topic of our deep dive today. We are looking at the 11 Incoterms of 2020.
Yes, the 2020 framework.
And I know they might sound like a lineup for a European football team or some obscure technical jargon, but these three-letter acronyms are actually the ultimate boundaries of international business responsibility.
They really are. They answer the two most critical questions of any transaction across borders, which is who pays the costs and who holds the financial risk.
Right. So what kind of sources are we pulling from today?
Well, we're looking directly at the rules published by the International Chamber of Commerce. They update these terms every decade, which is why we're specifically analyzing the 2020 version.
Makes sense.
Yeah, they basically give a buyer in Toronto and a seller in Tokyo a shared language. By just dropping three letters onto a commercial invoice, both parties instantly map out this highly complex legal and financial agreement.
An agreement covering like customs, insurance, freight, and liability.
Exactly. It's all baked into those three letters.
So our mission for this deep dive is to break down these 11 essential terms, divide them into how they actually dictate transit, and understand the strategic reasons a business would choose one over another.
A highly practical breakdown.
Right. And then later on, we are going to look at how these seemingly rigid logistics rules are actively manipulated to facilitate international financial crime.
Yeah, the transition from simple logistics to trade-based money laundering is, it's where this gets highly relevant for the global banking sector.
Because these acronyms are doing a lot of heavy lifting behind the scenes.
Oh, for sure. They are foundational to global finance.
Well, before we get into the financial crime aspect, which is fascinating, we need to lay the groundwork. Let's start with the rules that apply no matter how a product is traveling.
Right, the multimodal terms.
Yeah, whether it is packed onto a truck, loaded onto a freight train, flown via air cargo, or, a mix of all three, we'll categorize these as the any mode terms.
Okay, that's a good place to start.
And logically, we should probably start with the baseline, right? The absolute lowest level of responsibility for a seller.
Yeah, so the absolute floor for seller liability is a term called EXW. That stands for Ex Works.
Ex Works.
Under Ex Works, the seller basically manufactures the goods, packages them, and just leaves them at their own facility.
Wait, they just leave them there?
Pretty much. They notify you, the buyer, that the goods are ready, and their job is completely done. I mean, they don't load the truck, they don't handle export customs, they definitely don't arrange the freight.
Wow, it's basically the corporate equivalent of buying a couch on Craigslist.
That is a perfect analogy, actually.
Like you pay for the item, but you have to bring the truck, carry it out of their living room, and drive it home yourself. And if you drop it on the sidewalk, that's your problem, not theirs.
Exactly. You are entirely on the hook once they say it's ready.
But if I'm a massive corporate buyer, why would I ever agree to EXW? It sounds like a total logistical headache to arrange a pickup at some factory in a foreign country.
Well, it is a massive undertaking, but large buyers actually choose Ex Works for one primary reason, and that's absolute control over their supply chain.
Control? How so?
Think about it. If you are importing components from, say, 5 different factories in the same region of a foreign country, you don't want each factory arranging its own expensive shipping to you.
Oh, right. You'd be paying 5 different freight bills.
Exactly. So instead, you use Ex Works. You hire a third-party logistics provider to go around, pick up all 5 orders, consolidate them into one container, and ship them together.
At a much lower bulk rate.
You got it. It gives you total visibility and cost control.
Okay, that makes sense. But the friction there has to be the export customs, right?
Oh, absolutely. That is the huge sticking point.
Because if I'm an American buyer purchasing X works from a factory in Vietnam, I probably don't hold the local licenses required to actually clear those goods through Vietnamese customs.
Which is the primary reason the ICC recommends moving one step up the responsibility ladder
Okay, to what?
to FCA. That stands for free carrier.
Free carrier.
Got it. With free carrier, the seller clears the goods for export in their home country. So that solves your customs problem.
Nice.
And then they load the goods onto a carrier, say, a trucking company or a rail line at a specific named location.
Does that have to be at their factory?
Not necessarily. That location could be the seller's own loading dock, or it could be a nearby freight terminal. But the really pivotal moment is the handoff.
The moment they give it to the truck driver.
Right. Once the goods are handed over to that initial carrier, the risk completely transfers to the buyer.
Interesting. This feels like the exact moment trade finance usually kicks in.
How do you mean?
Well, once the seller hands the goods to that carrier, they get a transport document, right? Like a receipt proving they did their part.
Yes, a bill of lading or a waybill, exactly.
And they can take that document straight to their bank to get paid, even while the goods are still physically in transit.
You are touching on a very crucial mechanism there. The entire trade finance ecosystem relies on those specific handoff moments.
Because the bank needs proof.
Right. The bank releases funds based on the transport documents that are generated exactly when the Incoterm says risk transfers.
Wow. Okay. Let's follow that thread into the next two any mode terms.
Yeah.
We have CPT, which is carriage paid to, and CIP, carriage and insurance paid to.
Yep. The CO terms.
So under CPT, the seller takes on more of the financial burden, right? They pay the freight cost to move the goods all the way to a named destination in the buyer's country.
That's correct. They pay for the ride.
And CIP is the same setup, plus the seller pays for insurance. But looking at our sources, there's a major nuance here regarding the risk.
A huge nuance.
Because it says under CPT and CIP, the seller pays for the transport all the way to the destination, but the financial risk still transfers to the buyer the moment the goods are handed to the first carrier at the origin.
Yes. And this is the single most misunderstood concept in international trade.
Wait, really? So the seller pays for the transport, but they don't hold the risk?
Exactly. Paying for the ride does not mean taking responsibility for the crash.
That is wild.
It's totally counterintuitive, right? Under CPT and CIP, the seller opens their wallet and pays the logistics company to move the goods from, let's say, a facility in Munich to a warehouse in Chicago.
Okay.
But the physical risk of those goods being damaged transfers to the Chicago buyer the second that truck leaves the Munich facility.
So if the truck crashes in Germany, the Chicago buyer is the one who has to file the claim, even though the Munich seller was the one who actually hired the trucking company.
That is exactly how it works.
That seems so unfair to the buyer. What is the strategic rationale for separating cost and risk like that?
Well, it mostly comes down to purchasing power.
Oh, like negotiating rates.
Right. The seller in Munich might export thousands of containers a year, which gives them tremendous leverage to negotiate lower freight rates, so they arrange the shipping to save money.
But they don't want the liability.
Exactly. Because once the goods are moving, the seller has no physical control. It's actually more practical for the buyer, who is the one receiving the goods, to manage the insurance claims locally if something arrives broken.
Ah, I see. Because the broken goods are ending up in Chicago anyway.
Right. The ICC actually updated the CIP rules in 2020 specifically because of that exact dynamic.
What changed?
Previously, a seller under CIP only had to provide minimum cover insurance, but buyers were getting burned when cargo was damaged, and the payout didn't cover the full value of the goods.
Oh, that's right.
Yeah. So now, under the 2020 rules, CIP requires the seller to purchase comprehensive insurance, specifically what's called Institute Cargo Clauses A, which covers all risks.
So it offers much better protection for the buyer who is holding the liability during that whole transit.
Exactly. It levels the playing field a bit.
Okay, so we've covered the terms where the risk transfers at the origin. Now let's look at the D terms, the advanced delivery terms. We've got DAP, DPU, and DDP.
The heavy hitters for seller liability.
Yeah, this is where the seller carries the risk all the way to the destination. So under DAP, Delivered at place. The seller gets the goods to your specific address, but the buyer is responsible for unloading the truck.
It sounds simple, but unloading is actually a critical friction point.
How so?
Well, imagine you are receiving heavy industrial equipment under DAP, and your forklift accidentally damages the goods while pulling them off the trailer.
Oh, no.
The seller is not liable for that. The risk transferred the exact moment the truck parked.
Right, because it arrived.
Exactly. If you want the seller to take the risk of the actual unloading process, you have to use a different term. You use DPU.
Delivered at place unloaded.
Exactly.
That implies DPU is used a lot when specialized equipment is required, right? Like if I don't have the heavy cranes at my facility to safely remove a massive generator from a flatbed.
You definitely wouldn't want DAP.
Right, I would force the seller to use DPU, making them arrange and take the risk for the crane operation at my site.
It transfers that whole operational headache right back to the seller. And the final any mode term takes that to the absolute extreme.
DDP, delivered duty paid.
Yes, if X works is the seller doing the bare minimum, DDP is the seller taking on maximum liability.
So they do everything.
Everything. They handle freight, they hold all the transit risk, they manage export and import customs, and they pay all local taxes and duties in your country.
I mean, as a buyer, DDP sounds like an absolute dream. The goods just magically appear in my warehouse, fully cleared and ready to go.
For a buyer, it is great, but for a seller, managing import customs in a foreign jurisdiction sounds like a total nightmare.
Oh, I bet.
You'd have to register for VAT or local tax IDs in a country where you don't even have a physical office. Sellers regularly run into massive delays with DDP because they just lack the local licenses to clear goods through foreign customs.
And since they hold the risk, what happens?
The goods get impounded at the border, and the seller eats the financial losses for the delay. Executing DDP successfully requires a highly sophisticated compliance team.
Wow. Okay, so that covers the any mode terms. But if these terms can theoretically cover any type of transport, including ships, why is there a completely separate category of terms exclusively for sea and inland waterways?
That's a great question.
Because the ICC dedicated 4 specific terms just for maritime freight. FAS, FOB, CFR, and CIF. Why separate them out?
Well, maritime law is ancient, for one, and the nature of ocean freight is just fundamentally different from, rolling a boxed television onto a truck.
Sure, the scale is different.
The scale is massive. These 4C terms are generally restricted to bulk commodities. Think millions of gallons of unrefined oil or thousands of tons of grain.
Or like out-of-gauge heavy machinery that cannot fit into standard shipping containers.
Exactly. The physical act of loading these goods onto a vessel is so uniquely perilous that it requires its own specific legal framework.
Okay, let's start with the first one. FAS, free alongside ship.
With FAS, the seller clears the goods for export and places them on the dock or jetty right next to the designated vessel at the origin port.
So they don't actually put it on the boat.
Nope, they just park them within reach of the ship's loading cranes. From that exact moment, the buyer assumes the risk and the cost to hoist the cargo up and secure it for the ocean crossing.
This makes total sense for something incredibly heavy, where the ship itself or specialized port infrastructure has to physically lift the cargo.
Exactly. It defines who is responsible for the lift.
But if I want the seller to manage the loading process, we move to arguably the most famous acronym in supply chain history, FOB, or free on board.
Ah, yes. FOB is truly iconic. And it's iconic because the transfer of risk is tied to a highly specific physical moment.
The ship's rail, right?
Historically, yes, the literal ship's rail. If a crane was hoisting a crate of goods over the water and the rope snapped while the crate was suspended over the dock.
The seller is liable.
Right. But if the crane swung the crate a few feet further, crossing the invisible vertical line of the ship's rail, and then the rope snapped.
The buyer is liable for the goods smashing onto the deck.
You got it.
It's like a high-stakes baton pass. In a track relay, the runners have a specific zone where the baton must change hands.
That's a great way to picture it.
The tension isn't about running the lap. It's about who drops it during the handoff. FOB isolates the liability of that exact swing of the crane. Yeah. Though my understanding is the 2020 rules modernized this slightly.
It did, yeah.
Moving away from the ship's rail to when the goods are safely on board the vessel.
The ICC updated it because the exact vertical plane of a ship's rail is nearly impossible to prove in a modern, busy port environment.
Right, who's out there measuring invisible lines.
Exactly. But the principle remains. The risk transfers at the precise moment the loading is complete. Buyers love FOB because it allows them to control the ocean freight.
They get to pick the shipping line.
Yes, they choose the shipping line, negotiate the transit times, and control the routing, which is absolutely vital when you're managing inventory levels across complex global markets.
Okay, so if the buyer doesn't want to arrange the ocean freight, we get to the final two C terms. CFR, cost and freight, and CIF, cost, insurance, and freight.
The maritime equivalents of CPT and CIP.
Right. By applying the logic we established with the any mode terms, CFR means the seller pays for the ocean transit, but the risk still transfers to the buyer back at the origin port.
The moment the goods are safely on board.
The golden rule of separated cost and risk applies to ocean freight as well.
It absolutely does.
So if we return to our opening scenario, the cargo ship sinking midway across the ocean under CFR or CIF, the buyer holds the financial liability for those lost containers, even though the seller paid the shipping line for the journey.
They hold all the risk. And under CIF, the seller is required to provide marine insurance. But unlike the CIP term we discussed earlier, which now requires comprehensive all-risk coverage, the 2020 rules for CIF are different.
They still only require the seller to provide minimum cover insurance, right? Institute Cargo Clause Z.
Yes, that distinction is super critical. Minimum cover generally protects against catastrophic events, like a ship sinking or a major fire.
Nightmare scenarios.
Exactly. But it often doesn't cover routine damage, pilferage, or, rough handling during unloading.
So if a buyer is operating under CIF, they often have to purchase top-up insurance just to fully protect their financial interest.
Almost always. Otherwise, they're dangerously exposed.
Okay, so we've established the structure. We see how these 11 terms perfectly balance cost, risk, and control. They really act as the invisible gears of global commerce.
They keep everything moving.
But this is where the dynamic shifts. We need to transition from logistics to compliance. Because when bad actors analyze these exact same frameworks, they don't see logistics rules.
No, they certainly do not.
They see loopholes for international financial crime.
And this is a massive vulnerability within the global banking sector. As we said earlier, these terms form the absolute foundation of trade finance.
Right, because companies rarely just wire cash.
Exactly. When a company imports or exports, they use their banks to issue letters of credit. The bank guarantees payment upon presentation of specific shipping documents.
And those documents are structured entirely around the chosen Incoterm.
Entirely.
So how does a criminal syndicate weaponize an Incoterm?
Well, the most prevalent method is trade-based money laundering, or TBML.
TBML. Okay. How does that work in practice?
Let's take CIF cost, insurance, and freight as our mechanism. Under CIF, the total invoice price presented to the bank is a bundled number.
It includes the cost of the raw goods, the insurance premium, and the ocean freight charges all rolled into one.
Exactly. Now, suppose a bad actor in a country with strict capital controls wants to secretly move, say, $10 million of illicit wealth to an offshore account.
They can't just wire the $10 million out because the central bank would flag it immediately.
Right, the alarm bells would ring. They need a commercial justification to move the capital.
So they set up a shell company overseas.
Yes. They initiate a purchase of cheap, low-margin goods. Let's say $1 million worth of scrap metal.
Okay.
But they use a CIF contract. And the overseas shell company artificially inflates the freight portion of the invoice.
How inflated are we talking?
Well, they might claim the ocean freight and insurance costs are $9 million.
Which is an absurd markup for shipping scrap metal.
Totally absurd. But the goods themselves are accurately priced at $1 million, so an inspector looking at the physical cargo won't see anything suspicious.
Because the scrap metal is actually worth $1 million.
Exactly. The fraud is entirely buried in the logistics line item.
Wow. So the buyer's bank receives a commercial invoice for $10 million under a CIF term. They wire the funds to the overseas seller. The scrap metal arrives, worth exactly $1 million.
Yep.
But $9 million in pure cash has just been successfully laundered out of the country.
Justified on paper as freight costs. And because shipping rates fluctuate wildly based on fuel prices and seasonal demand, inflated freight is incredibly difficult for customs officials to spot on a dock.
That is brilliant in a deeply terrifying way. And I imagine criminals run this in reverse to evade taxes, too.
Oh, all the time.
Like, if you are importing highly taxed electronics under DAP or DDP, you intentionally under-invoice the cost of the goods and shift that value into an inflated freight charge.
Because import tariffs are calculated based on the value of the goods, not the freight.
Right. So you dodge the taxes while the total amount of money changing hands remains exactly the same. The structure of the Incoterm is actively shielding the shadow economy.
Which places a tremendous moral and regulatory burden on the banking sector. A trade finance compliance officer handling a letter of credit cannot just act as a rubber stamp, just checking off document names.
They really can't.
When they see a CIF or DDP contract, they are required to scrutinize the mathematical reality of the transaction.
They have to look at the market indices. Like, if shipping scrap metal from Mumbai to London averages $50,000 this quarter, and the CIF invoice claims the freight is $9 million.
The banker has to freeze the transaction immediately.
Because they are the last line of defense.
You absolutely are. They have to ask if the actual market price of these goods, plus the realistic logistics costs, genuinely aligns with the total invoice value under the stated Incoterm.
And if the numbers disconnect, they're looking at capital flight, tax evasion, or money laundering.
Exactly.
So an Incoterm isn't just an agreement about who hires a forklift.
Not at all.
It actually acts as a vital metric for transparency within the financial system. It is the mathematical proof that a cross-border transaction is economically legitimate.
They really are the barometers of global trade transparency. I mean, using these terms correctly keeps legitimate businesses protected from catastrophic losses, but aggressively auditing them is what allows international authorities to dismantle financial crime networks.
It is remarkable how deep this goes. We've moved from the friction of clearing export customs to the exact moment a crane lowers a container onto a ship's deck, all the way to a compliance officer hunting down laundered money buried in a freight invoice.
It connects everything.
By decoding these 11 terms, we really unlock a completely different view of how the global supply chain functions and where the vulnerabilities truly lie.
Once you understand the mechanics of cost and risk, the entire map of global trade finance becomes legible. It's a complex web, but it's holding the global economy together.
Well said. Before we wrap up this deep dive, I want to leave you with a final thought to ponder. The next time you order something from overseas and you're refreshing that tracking page online.
We all do it.
Right. Watching your package move from a foreign factory to a busy port, onto a ship, and eventually to a delivery truck. Think about those invisible handoffs happening at distant borders.
The baton passes.
Exactly. At this exact second, who is actually holding the financial risk for the package making its way to your door?